Bitcoin has just gone through one of its most volatile stretches this year. From hitting record highs in early October to suddenly plunging towards the $80,000 mark, the world's biggest cryptocurrency has wiped out almost all its gains for the year. And today, we will break down why exactly this happened, what's driving the fear in crypto markets, and what this could mean for the broader financial mood. First, the drop itself. What happened? Well, on the 21st of November, Bitcoin slid to around $80,000 before stabilizing near $86,000. That dip alone erased a significant chunk of its 2025 rally gains. And across the entire crypto universe, roughly $1 trillion in market value has disappeared. This was not a slow fade. This was a sharp correction, the kind that sends shockwaves through an already jittery market. So why did Bitcoin crash? Think of it as a storm made up of 5 forces. And each of these forces did not just nudge Bitcoin downward, they hit all at once. Risk sentiment collapsed globally. Bitcoin has increasingly been moving like a high-growth tech stock, not the uncorrelated digital gold some people still imagine it to be. Now, recently, global stocks fell due to worries that grew over a possible US government shutdown. Tensions flared up again in the US-China trade relations. Investors questioned whether AI-related valuations are frankly getting a little wild. As risk assets dropped, crypto followed. Bitcoin's correlation with major US market indices has climbed to levels not seen since the 2022 pandemic-era market stress. So, when stocks sneeze, Bitcoin seems to be catching a cold. Secondly, a hawkish shift in US monetary policy. Even though the US Federal Reserve cut rates in October, its stance afterward was anything but soothing. Officials signaled that a December rate cut is not guaranteed. That uncertainty spooked markets, especially assets that thrive on easy money and investor optimism, which includes cryptocurrency. Regulatory fog rolled back in. Momentum from earlier in the year faded as US progress on a key digital asset regulation bill stalled. The delay that was combined with political disagreements over rules for decentralized finance has slowed down mainly due to 3 factors: adoption, liquidity, and retail participation. Bitcoin's volatility jumped from 20% in August to 39% today, nearly double. And US retail usage dipped from 17% in the month of July to 15% in October. Remember, when regulation stalls, uncertainty rises. And when uncertainty rises, money tends to move out. So liquidity dried up fast. During the October 10th sell-off, exchanges saw order books thin out dramatically, in some cases with almost no offers for several minutes. Institutional investors have also been pulling money out of crypto funds and ETFs. Total crypto market capitalization has fallen about 24% from its recent peak. Now, if you're thinking, that sounds like a lot of forced selling, well, you are right. The fourth reason is profit-taking by long-term holders. So the selling this time did not come from short-term speculative traders. Long-term holders, the so-called diamond hands, sold over 800,000 Bitcoin in the past month. That's the most since January 2024. When long-term holders start taking profits, it signals something deeper. That is fear, rising volatility, and a shift in market psychology. The crypto fear and greed index fell to 11 on the 21st of November, which is the extreme fear territory. The plunge did not stop there. By the 21st of November, Bitcoin hit a 7-month low, hovering around the $80,553 mark, with Ether dropping to a 4-month low. Crypto did not fall alone. Tech stocks, especially AI-driven names, also tumbled, pulling crypto sentiment down with them. When the market's mood sours, crypto tends to feel it first. So Bitcoin is now down 12% for the week, down 12% for the year, and below the average price many big institutional buyers paid. That's important because when large investors hit break-even levels, some may have to sell to prevent losses. And remember that massive liquidation last month? Crypto is still shaken by a record single-day wipeout where $19 billion worth of positions were liquidated. Events like that don't just go away. They leave a mark, and traders sell more quickly the next time around. There's also a brewing problem, which is crypto treasury companies. These are companies that hold large amounts of Bitcoin on their balance sheets, betting that its value will rise. But if Bitcoin falls below certain thresholds, such as $90,000, according to some estimates, as many as half of these holdings could be underwater. That increases the risk of forced selling, which can add more downward pressure. So, what does all of this mean? Well, Bitcoin's sell-off is not just about crypto. It's a signal about broader market nerves. Risk appetite is weakening. Investors are uneasy about US interest rates. Technology stock valuations look stretched. Liquidity is getting thinner, and long-term confidence is wavering. Bitcoin, often treated as a risk barometer, is sending a warning signal. Is the crypto bull run over? Maybe, maybe not. History shows that Bitcoin can recover sharply after deep drops. But today, the mood feels fragile. And when Bitcoin wavers like this, it makes you wonder, what is it really saying about the wider market's confidence?